You know, I've made a lot of money in my life, billions, actually. But I've also watched thousands of people, good, hardworking people, destroy their financial futures with one simple mistake. And if you're over 50, you're probably making it right now. Let me tell you something that might shock you. The biggest financial mistake you can make at 50 isn't taking too much risk. It's not the stock market crash you're worried about. It's not even medical bills or inflation, though those are real concerns. No, the mistake I'm talking about is far more insidious. It's something your parents probably did, something your neighbors are doing, something that feels safe, feels right, feels like the responsible thing to do. But I'm here to tell you, after watching this destroy retirement after retirement for over 6 decades, it's financial suicide. I'm 94 years old. I've seen the Great Depression, multiple recessions, wars, market crashes, and every economic disaster you can imagine. And through it all, one pattern has remained crystal clear. People over 50 who do this one thing almost never recover financially. So if you're 50 or older, stop what you're doing and listen carefully, because what I'm about to share could be worth more to you than any stock tip I've ever given. Now, before I tell you what this mistake is, let me ask you a question. What do you think is the safest thing you can do with your money after 50? If you said move everything to bonds, or put it all in savings accounts, or get out of the market entirely, congratulations, you just identified the exact mistake that's destroying retirements across America. I call it playing dead with your money. Look, I understand the instinct. You've spent 30, 40 years building up your nest egg. You've seen market crashes. You've watched friends lose money. Your financial advisor who makes money whether you do or not tells you it's time to de-risk and preserve capital. It all sounds so sensible, doesn't it? But here's what nobody tells you. At 50, you're not near the end of your financial life. You're barely past the middle. Think about it. If you're 50 today and reasonably healthy, there's a good chance you'll live to 85, 90, maybe even 100. That's 35 to 50 years your money needs to work for you. 50 years, that's longer than most people's entire working careers. And yet, what do most people do? They panic. They take their life savings and stuff it into safe investments that barely keep pace with inflation. Treasury bonds yielding 4%, savings accounts at 3.5%, certificates of deposit that lock up your money for years. Let me run the numbers for you, because numbers don't lie. Let's say you're 50 years old with $500,000 saved for retirement. Not bad, you've worked hard for that. Now, you decide to play it safe. You move everything to bonds and savings accounts, averaging 4% annual return. In 20 years, when you're 70, you'll have about $1,095,000. Sounds good, right? Wrong, because here's what they don't tell you. Inflation has been averaging about 3% annually over the long term. After inflation, your safe return is really only 1% per year. So that $1,095,000 in 20 years will have the purchasing power of about $605,000 in today's dollars. You spent 20 years with your money locked up, and you gained only $105,000 in real purchasing power. That's $5,250 per year. You'd make more money working part-time at Walmart. Now, let's look at the alternative. What if you kept that same $500,000 invested in a diversified portfolio of quality businesses, the kind I've been investing in my whole life, averaging 9% annual return? In 20 years, you'd have approximately $2,802,000. After accounting for that same 3% inflation, that's about $1,547,000 in today's purchasing power. That's nearly $1 million more in real money, not play money, not paper gains, real purchasing power that can pay for your health care, your grandchildren's education, your dignity in old age. The difference between these two approaches isn't just numbers on a screen. It's the difference between a comfortable retirement and a desperate one. It's the difference between being a burden to your children or leaving them a legacy. It's the difference between spending your 70 seconds worried about every expense or actually enjoying the fruits of your labor. But Warren, you might say, what about the risk? What if the market crashes? Well, let me tell you about risk. I've lived through 15 recessions. I've seen the market drop by 50% or more on 4 separate occasions. And you know what? Every single time it came back. Every single time. The S&P 500 has delivered an average annual return of about 10% since 1928. That's through the Great Depression, World War II, the Cold War, stagflation, the dot-com crash, the financial crisis of 2008, the COVID pandemic, everything. If you're 50 years old today and you're planning to live to 85, you have 35 years. Do you know how many 35-year periods there have been in stock market history where investors lost money? 0. Not a single one. The real risk isn't owning stocks. The real risk is not owning them. You know what the actual biggest risk to your retirement is? It's not a market crash. It's running out of money at age 82 when you've got another 10 years to live. It's watching inflation slowly eat away at your purchasing power until your safe nest egg can't even cover your basic expenses. I've seen this happen to countless people. They retire at 65 with what seems like plenty of money. They've got it all in safe investments. And then, 15 years later, they're shocked to discover that their costs have doubled, but their income has barely moved. They start cutting back. First it's vacations, then it's restaurants, then it's medications. Before they know it, they're 80 years old, rationing their spending, dependent on their children, living in fear. That's not safety. That's slow-motion financial suicide. Now, I'm not telling you to put all your money in tech startups or cryptocurrency or whatever the latest craze is. That would be foolish. What I'm telling you is that your 50 seconds, 60 seconds, and even your 70 seconds are not the time to abandon the principles that built your wealth in the first place. You need to keep your money working in quality businesses, companies with strong competitive advantages, excellent management, and the ability to grow their earnings over time. You need to stay diversified. You need to think long-term. Because here's something else. Nobody tells you the wealthy don't get out of the market when they turn 50. I'm 94 years old, and Berkshire Hathaway is still fully invested in stocks. I'll be invested in stocks the day I die. And you know what? So should you be. The fear of losing money is natural, but it's causing people to make decisions that guarantee they'll run out of money instead. Now let me tell you about 3 threats to your retirement that nobody wants to talk about, and why playing dead with your money makes all of them worse. The first threat is inflation. And I don't mean the inflation number they report on TV. I mean the real inflation you experience in your actual life. Healthcare costs have been rising at about 6% per year for the past 2 decades. That's double the general inflation rate. If you're 50 today, the medical expenses you'll face at 80 will be roughly 4 times what they are now. 4 times. Your prescription that costs $100 today, it'll be $400. That medical procedure that costs $50,000, it'll be $200,000. And if you think Medicare covers everything, I've got some bad news for you. Housing costs, property taxes, insurance, they're all rising faster than general inflation. Even if you own your home outright, your property taxes in 30 years might be triple what they are today. So when you put your money in bonds yielding 4% and inflation is running at 3%, you're only gaining 1% per year, and that's against general inflation, not the higher inflation rates for things retirees actually spend money on. You're not preserving your wealth. You're slowly going broke in the most expensive way possible. The second threat is longevity. People are living longer than ever, and this is actually a wonderful thing unless you run out of money first. When Social Security was created in 1935, the average American died at age 61. The retirement age was set at 65. The system was designed expecting people would collect benefits for just a few years. Today, if you're 50 years old and healthy, there's a 50% chance you'll live past 85. There's a 25% chance you'll live past 90. There's a 10% chance you'll live past 95. And here's the kicker. These numbers keep improving. Medical advances are accelerating. If you're 50 today, you might easily live to 100. That's 50 years in retirement, half a century. Your money needs to last that long, and it needs to grow along the way to keep pace with inflation. If you're earning 1% real returns, your money will run out. It's not a question of if, it's when. But if you're earning 6% real returns, which is achievable with a sensible stock portfolio, your money can last indefinitely and even grow. The third threat is the cost of care. And this is the one that destroys more retirements than anything else. The average cost of a nursing home today is about $100,000 per year. Assisted living is about $50,000 per year. In-home care can easily run $50,000 to $75,000 per year. Now remember what I said about healthcare inflation running at 6% per year. In 25 years, when you're 75, that nursing home will cost about $430,000 per year. Per year. Even if you only need care for 3 years, and many people need it much longer, that's $1.3 million. Can your safe bond portfolio handle that? Because I can tell you right now, most can't. This is why keeping your money growing is not optional. It's essential. But there's something even more important I need to tell you, and it might surprise you coming from me. The biggest threat to your retirement isn't financial at all. It's psychological. When you move all your money to safe investments at 50, you're not just making a financial mistake. You're making a mental one. You're telling yourself that your productive years are over, that you're in decline, that you should start winding down. And you know what happens? You start acting like it. I see this all the time. Someone retires at 60 or 65, moves their money to bonds, and suddenly they're old. They stop learning. They stop growing. They stop engaging with the world. They vegetate in front of the TV, complaining about their aches and pains, waiting to die. That's not retirement. That's giving up. I'm 94 years old, and I still go to work every day. I still read 500 pages a day. I still make billion-dollar decisions. I still learn new things. You know why? Because I never told myself I was done. I never moved to the sidelines. I never started preserving instead of growing, and my money never stopped working either. Here's what I want you to understand. The way you manage your money after 50 is a statement about how you're going to live the rest of your life. Are you going to be in growth mode or decline mode? Are you going to keep moving forward or start retreating? Because if you tell your money to stop growing, you're telling yourself to stop growing too. Now, some of you are thinking, but Warren, you're rich. You can afford to take risks. I can't. That's exactly backwards. I can afford not to take risks. If all my stocks went to zero tomorrow, I'd still be fine. But you can't afford not to take intelligent risks with your money. You need it to grow. The wealthy don't get out of the market because they understand something crucial. The stock market isn't a casino. It's a mechanism for owning pieces of productive businesses. When you own stocks, you own companies that make products, serve customers, earn profits, and grow over time. Over any long period, and remember, 35 years is a very long period. You will make money owning good businesses, not might. Will. The question isn't whether you can afford to stay invested. The question is whether you can afford not to. All right, so if moving to all bonds and cash is financial suicide, what should you do instead? Let me give you my roadmap for people over 50. First, accept this truth. You're not old. Not financially, anyway. You've probably got 35 to 50 years ahead of you, and your money needs to work for every single one of those years. That means staying invested in stocks. Now, I'm not saying you should have 100% of your money in stocks if you're 50, but I am saying you should have a substantial portion, probably somewhere between 50% and 80%, depending on your specific situation. Here's a simple rule I've always followed. Keep enough in safe, liquid investments to cover 3 to 5 years of living expenses. Everything else should be working hard for you in quality businesses. Let's say you need $60,000 a year to live on in retirement. Keep $180,000 to $300,000 in bonds, CDs, or a high-yield savings account. That's your safety cushion. If the market crashes tomorrow, you've got 3 to 5 years to wait it out without selling a single share. Everything else? Invest it in wonderful companies at fair prices. Now, what makes a wonderful company? I've spent my entire life figuring this out, so let me share what I look for. First, a strong competitive advantage, what I call a moat. This is something that protects the company from competition. Maybe it's a powerful brand like Coca-Cola. Maybe it's a network effect like American Express. Maybe it's cost advantages like Walmart. Whatever it is, it means the company can maintain its profitability over decades. Second, excellent management. I want managers who act like owners, who think long-term, who are honest with shareholders. You can usually tell this by reading their annual letters and seeing how they talk about setbacks and mistakes. Third, consistent profitability and the ability to generate cash. I don't invest in businesses that burn money, hoping to maybe make profits someday. I invest in businesses that make real money right now and will make more money in the future. Fourth, a business I can understand. If I can't explain in simple terms how a company makes money, I don't invest in it. And neither should you. If this sounds too complicated, let me make it simple. Invest in broad index funds. A low-cost S&P 500 index fund gives you ownership in 500 of America's best companies. You get instant diversification. You get professional management for almost no cost. And historically, you'll beat about 90% of professional money managers over time. In fact, when I die, my will instructs that 90% of my wife's inheritance be invested in an S&P 500 index fund. That's what I recommend for most people, and that's what I'm doing for my own family. Now, here's the discipline part, and this is where most people fail. Once you're invested, you have to stay invested. The market will go down. That's not a possibility. It's a certainty. There will be recessions. There will be crashes. There will be years when your portfolio drops by 20%, 30%, maybe even 40%. And when that happens, you cannot panic. You cannot sell. You have to remember why you invested in the first place. Because over the long term, quality businesses grow and create wealth. In fact, market crashes are gifts. They're opportunities to buy more shares at lower prices. I get excited when the market crashes because everything goes on sale. But most people do the opposite. They buy when everyone's optimistic and prices are high, and they sell when everyone's panicking and prices are low. They buy high and sell low. And then they wonder why they don't make money in the market. Here's what you do instead. Set up automatic investments. Every month, have money automatically moved from your checking account into your investment account. Buy more shares. Don't look at the news. Don't check your balance every day. Just keep buying. When the market goes up, you're buying. When the market goes down, you're buying more at lower prices. Over time, this simple discipline creates tremendous wealth. Now, let me address one more thing. What about your age? Shouldn't you be more conservative as you get older? Yes, but not the way most people think. Being conservative doesn't mean abandoning stocks. It means being more selective about which stocks you own, keeping a larger cash cushion, and having a plan for where you'll get money for living expenses without being forced to sell during a crash. Even at 80 or 85, you should still have money invested in stocks because you might live to 100. Your money needs to keep working. I'm 94 years old, and Berkshire Hathaway's portfolio is overwhelmingly stocks, because even at my age, I'm thinking decades ahead. I'm thinking about where this company and these investments will be in 2040, 2050. You should be thinking the same way. Let me close with this. The financial decision you make at 50 will determine whether your retirement is comfortable or desperate, whether you maintain your independence or become dependent on others, whether you spend your later years in dignity or in fear. Choosing safety isn't safe. Hiding from the market isn't protection. Moving all your money to bonds and cash isn't preservation, it's capitulation. Stay invested. Stay disciplined. Stay focused on quality. Give your money time to work for you, because at 50, you're not winding down. You're positioning for the last and possibly the most important third of your life. The biggest risk you face isn't losing money in a market crash. It's running out of money at 85 because you were too afraid to let it grow. So stop playing dead with your money. Keep it alive, keep it working, keep it growing. Your future self will thank you for it. And remember, the best time to plant a tree was 20 years ago. The second best time is today. The same is true for your investments. Now get to work.